How do we create somewhat of a template to go by when assessing a particular project? The 5-layer pricing framework. So this is the exact framework I use when evaluating any property for myself or for serious investors. Number 1, replacement cost. So the intrinsic value, right? First, we take a look at and we ask ourselves the question, what would it cost to build this today? So that's going to include the land value, the construction cost, financing, developer margin, and government fees. That gives me an insight into the intrinsic floor, the real cost of creating this asset. If I'm buying close to or below replacement cost is a strong location. My downside is protected. That's not marketing. That's going to come down to asset logic. And in Dubai, there are certain developers that don't pay for land costs, which are government-backed developers. So that may add further value, or you may be getting a better price. That's just an example. The second point of the framework, true comparables, real market validation. Any asset that you're now going to be analyzing, whether it's a car, whether it's gold, whether it's real estate, you have to take a look at the true comparables, not launch prices, not advertised prices, actual transactions that have existed in that area before. So I compare the same area, similar views, similar size and layout, and similar handover timelines. If I'm paying 20 or 30% more than the comparable stock, that premium must be justified by something real. Is it a superior location? Is there true scarcity? Is it brand positioning or future repositioning of the area? Or is it just new and shiny? For me, that's not real value. That's now marketing. Third point, real demand. Who's actually buying this? So when it comes to most clients, especially international clients, this is where most people are getting misled. I ask, who genuinely wants this product? Is it end users? Is it international investors? Lifestyle buyers? Is it just golden visa clients? Then I look at how deep that buyer pool is, how price sensitive they are, and how global that demand really is. Dubai does not move on population growth alone. It moves on capital flow. So when the demand is international, diversified, and emotionally linked to lifestyle or status, prices are more resilient throughout market cycles. Point number 4, future scarcity. This is where long-term money is made. And the question I ask is, can more supply realistically come to that area? Is it beachfront, waterfront? Is it within a golf course? Is this an area becoming part of the city's core? Is new infrastructure changing accessibility and desirability? When a location moves from emerging to established, prices just don't increase, they reprice. This is how investors make 30, 50, even 80% over a cycle, not through hype, through the evolution of the city in line with the master plan. And fifth, final point, risk-adjusted return. This is where professionals remove emotion. I calculate capital appreciation potential, rental yield after service charges, liquidity on exit, developer execution risk, and market cycle timing. Then I ask myself one question. For the risk I'm going to take, is the return fair? If another asset offers similar returns with less risk, this is not a good deal, even if that brochure looks perfect. So then, let's do this. A simple test. Let's say we remove the branding, we remove the influencers, the great launch events, and the sales story. And I'll look only at the location, demand, scarcity, and how my investor or myself can exit with great liquidity. Does it still make sense? If yes, that's what I call value. If it only works with the story, that's hype. And why does it matter? The biggest mistake I see buyers making in today's market is focusing on price instead of value. A property that looks cheap can be expensive if it doesn't grow, if it doesn't rent well, and it's hard to sell. At the same time, a property that looks premium can actually be a better deal if the demand is deep, the scarcity is real, and the exit market is strong. This is the difference between buying a property and building a portfolio. So I built this framework because I didn't want to guess anymore, not that I have. And I don't want my clients guessing either. Dubai is one of the most powerful real estate markets in the world. And if you can understand how to read it, if you think or want to think like an investor, not just follow headlines, this is how I do it. And if there's a project you're unsure about, drop it in the comments or message me. I'd rather help you make a smart decision than a fast one.